And now, the fourth team, representing Central America, BARNA Management School. Please welcome them to the stage.
Good evening, everyone. We are the BARNA Management School team from the Dominican Republic, and we're here to present our analysis for Coca-Cola FEMSA, KOF for short. KOF is the largest Coca-Cola bottler in the world, accounting for selling 1 out of every 7 Coca-Cola products sold worldwide. They have a diversified geographic footprint, operating in 9 Latin American countries and the Philippines in Asia, serving more than 375 million consumers. We are issuing a buy recommendation with a target price of $82.88, reflecting a 17% upside potential from its closing price as of January 5th. Our recommendation is based on strong competitive positioning, sound cash generation, and significant growth opportunities.
KOF operates in 2 of the most attractive markets for the soft drink industry, which are highly competitive, and companies stand out through pricing strategy, packaging, portfolio diversification, and point-of-sale execution. KOF's biggest competitors are PepsiCo bottlers, such as Cultiva, Ambev, Postobon, and Pepsi-Cola Philippines. The company competitive advantage consists of a vast distribution network with nationwide reach in half of their territories, Coca-Cola brand strength as the #1 brand in the beverage industry, operational know-how in emerging markets, and a strong relationship with the Coca-Cola Company and FEMSA. All these allow the company to be the undisputable leader in carbonates with more than 50% of market share.
KOF product portfolio has more than 150 brands, composed by sparkling, still, and water categories, with sparkling representing almost 80% of their sales volume. However, consumers are asking for healthier beverages and less caloric drinks, for which KOF has proactively diversified its product portfolio, focusing on healthier product lines. This reflects the company's ability to adapt to new trends. KOF is currently consolidating its bottling businesses in Latin America, strengthening their geographic position, as well as vertical integrating with the raw materials producers, seeking to reduce cost and mitigate commodity price exposure.
This company has encountered obstacles along the way, from regulations on carbonated soft drinks to hyperinflationary economies such as Venezuela. Nonetheless, the company has been able to generate cash flows by shifting capacity and expanding to different territories, showing its resilient nature.
Moving forward, countries in Latin America are showing signs of recovery, with disposable income expected to increase 3.1% on average in KOF territories. Specifically, the Philippines is expected to increase 6.4%. This is important as we have found a strong correlation between soft drink consumption and disposable income. Moreover, these countries have an elevated per capita consumption, with Mexico, Brazil, and Argentina more than doubling the world's average.
We believe KOF is well positioned for growth through acquisitions of new bottlers and brands, introductions of new products, and new pricing strategies. Acquisitions boosted in part by the Bottling Investment Group, a special division of the Coca-Cola Company that acquires bottlers in need of help, stabilizing their operations and then finding a qualified bottler to sell it to, for which KOF has a priority pick. Introductions of new products like Coca-Cola No Sugar helps KOF to innovate in the carbonate category. And new pricing strategies, such as raising prices above inflation, has proven successful. As for the last 2 years, KOF has increased their revenues, and 2017 is on its way to be the best year yet.
Let's look at their financial highlights. For the last 10 years, KOF's revenues has grown at an average rate of 11%, always producing positive operating cash flows. KOF has the strongest cash generation to sales ratio among its peers, which has allowed them to consistently pay dividends to its shareholders and currently deliver a dividend yield of 2.65%. The company's operational performance can be seen in its superior EBITDA margin when compared to most of its peers. Going to the bottom line, we expect the net margin to increase from 5.9% up to 7.1% by 2022.
KOF has created these centers of excellence. Internal departments focus on reducing operating costs and increasing productivity. While implementing commercial and manufacturing initiatives, they have improved their point of sale execution, resulting in a 5% revenue growth in the implemented territories and obtained savings representing almost 7% of their net revenue. From 2013 to 2016, KOF has reduced their selling expenses to sales ratio by almost 200 basis points. We expect this performance to continue as KOF rolls out the remaining COEs initiative and exploit the synergies of their recently acquired businesses. All of this achievement can be attributed to their management team, with an average experience of more than 16 years in top executive position in the industry, and in some cases, more than 30 years in the Coca-Cola Company system.
This brings us to our valuation. Our target price is based in a hybrid valuation methodology using both the DCF to the firm and relative valuation multiples, attributing a weight of 65 and 35% respectively. For the peer multiple, we reviewed over 100 companies and narrowed it down to 5 comparable peers. We chose Dr. Pepper Snapple, 3 Coca-Cola beverage partners, and Suntory beverage brands. These were selected for having similar market caps and operations. We used the EV to EBITDA multiple, arriving at a target price of $81.24, representing a 15% upside potential from its closing price. It is important to know that for the last 5 years, KOF has been trading at a premium over its peers. However, it currently shows a discount of 31% below the industry median. We believe this discount is based on economic factors such as Mexico's liberalization of fuel prices and underperformance of South American economies. Therefore, we believe that with a diversified geographic footprint, a favorable macroeconomic outlook, and with improving efficiencies in recent acquisitions, KOF will be trading at the industry median in the near future.
We use the unlevered DCF based on assumptions related to historical results and management guidance. And using a WACC of 8.9% to discount these cash flows, we arrived at a stock price of $83.77, reflecting an 18% upside potential. For revenues, we analyze sales volume and average price per unit case through a bottom-up approach by evaluating each country individually and then aggregating the results. We believe this gives us a better estimate of the future performance of the company, arriving at an annual growth of 5.7% up to 2022. For the cost of goods sold, we incorporated the currency exchange rate and commodity prices into the model. We expect cost of concentrates to increase for the next 3 years and sugar prices stabilizing after a peak in 2016.
Our command valuation suggests a 17% upside potential. On top of that, if we take into account dividend payouts, this potential would increase to 19.86%. We also performed a Monte Carlo simulation to stress the main variables of our model and their underlying components. These variables can be seen on the right side of the presentation. From this analysis, we identified a 66.5% probability of a buy recommendation. We also created a football field graph to see how our valuation sat when compared to the stock's other multiples and 52-week high and low. As you can see, this supports our thesis that the stock is trading at a discount with further upside potential.
Now to the risks. We believe the main risks for the company are currency volatility, raw material exposure, changing on economic conditions, and the dependency on the Coca-Cola Company. For the currency volatility, KOF mitigates through forward agreements, options, and cross-currency swaps. Moreover, KOF has shifted their debt exposure to the US dollar from 29% in 2014 to less than 1% in 2017, practically eliminating it in favor of debt in Mexican peso and Brazilian real.
For the second risk, raw material exposure, the company purchases commodity price contracts to protect against unexpected swings, most commonly hedging sugar and aluminum, as combined, these represent over 30% of their cost of goods sold. And regulations, such as taxation of sparkling beverages, could affect the company's top-line performance. However, most of the territories where the company operates already have these in place. To wrap up, we believe that KOF's stock price does not reflect the company's strong competitive positioning, sound cash generation, and significant growth opportunities. Strong results in 2017 compared to 2016 lead us to believe that end-of-year results will be the catalyst that starts the progressive repricing of this security. Therefore, we strongly believe in our buy recommendation with a target price of $82.88 for a 17% upside potential from its closing price. Thank you for your time, and the floor is now open for questions.
When I think of a company that has Latin American exposure, South American exposure, unfortunately, the first thing I think of is Venezuela and the exposure to hyperinflation. How has the company mitigated its risks related to Venezuela, and how much of the assets are actually located there?
Right? For Venezuela, the company has shown its resilience when in 2015 it went into hyperinflationary status. However, if you can see the cash flow statements, the company's cash flow and dividend payout have not been affected by it. What the company has done to mitigate this is they have shifted capacity from Venezuela to South America, such as Brazil and Argentina. An example being Bompar, a Brazilian bottler, and Ades, a brand of healthy beverages, to diversify in other regions. In addition to that, Southeast Asia, with that acquisition, which was incorporated in 2016, has also been done to mitigate the exposure to Venezuela, which 4 years ago was 30% of the revenues. However, today it is less than 5%, showing that even though it has shifted drastically, the company's performance and cash flows have not been altered or affected.
Could you go back to your DCF analysis? Your cost of equity seems really low. I just wonder how you arrived at that, given the high-risk profile of this company.
For the cost of equity, we took into account that the capital asset pricing model, and then we adjusted for the country risk premium weighted in the percentage that the revenue have from this in these countries. However, we have to take into account that more than 50% of the revenues of the company come from countries, come from countries where they have investment grade by the credit agencies like S&P and Moody's.
You use 65% for discount cash flow model and then 35% for relative. How would the discount dividend model would look like? The dividend yield is 2.6%, I think you mentioned. And then how did you consider that model, or did you?
Yes, at the beginning we considered using the dividend discount model, as the company has a history of paying dividends, but given the strong tendency of the company to invest and acquire other companies and other brands, we decided that not all the money was going to investors or shareholders. So we discarded this method, and we wanted to keep more in line with the common practice of the industry using the EV to EBITDA multiple and DCF.
So given the upcoming election in Mexico and the economic environment and the NAFTA trade on the table, how do you see a consumer discretionary product like this to be affected?
Thank you for the question. For the first part, we incorporated political risk, like you mentioned, upcoming elections in some of South American economies, in our country risk premium, in our discount rate. For the NAFTA negotiations, however, we analyzed the treaty and saw that it primarily affects textile, agriculture, and automobile industries. Therefore, while it will not affect the company directly, we recognize it could affect Mexico's economic stability. And based on that, it could cause investors to pull out of Mexico and indirectly affect the stock price. However, if that were to happen, we would consider it would be based not on the company's fundamentals and consider there would be a good entry point for the business. However, we do recognize that it is a possibility.
There's a great deal of benefit that Coca-Cola FEMSA receives from the brand equity of Coca-Cola itself. The price, of course, of that comes through concentrate. And what percentage of the cost of goods sold is concentrate that's purchased from the parent, from Coca-Cola? And how do the alignment of interests work themselves out that Coca-Cola can't benefit excessively from this commanding position that it has?
Okay, thank you for your question. Around 40% of the cost of goods sold are concentrates. And it is true that Coca-Cola brand's equity is fundamental for KOF, as they are the largest Coca-Cola bottler in the world. What we see is that as we operate in emerging markets like Latin America and Southeast Asia, we can see that it's still growing, and people are still consuming sodas and sparkling beverage in these kind of countries.
In addition to that, Coca-Cola holds an important part of the voting rights of the company, and they call the bottlers partners. So they don't only invest, doesn't only invest, but they help in the business too.
So in the fourth quarter of 2017, the company had a big loss. And why was that, do you know?
The loss presented in the last quarter of 2017 was due to accounting practices. They evaluated Venezuela as fair value, but it was a non-cash transaction. It didn't affect the cash flows of the company.
Is that the only reason, or there were others?
That's the main reason.
So you mentioned an attractive acquisitions pipeline. Can you just address the balance sheet strength and how much capacity they have to do acquisitions?
Sure. For their acquisitions, their debt level is around 1.2, their ratio, but they are mainly focusing on using cash for new acquisitions. And because they have with the banks, they cannot go over the net debt to EBITDA ratio over 2 times. And they are very careful to keep it under that.
Can you tell me more about the sugar tax and what kind of impact did it have on KOF?
Yes,
Sure.
I'll take that one. The sugar tax affected the country in 2014, affecting the revenues in Mexico mainly, but we have seen that through our investigation that people adjust the budget to their, as a consumer staple. People don't stop consuming it. The revenues start recovering, as you can see in the chart behind me. In 2015, 2016, they start recovering their revenues and adjusting their pricing strategies in order to maintain market share and increasing revenues year over year. So the company has been resilient on that, and the management team have been taking the right decisions in order to be competitive in the market.
What about Philippines? What about the
The Philippines, they can't use the same strategy due to they are more elastic to the prices. They use different strategies with packaging and diversifying the portfolio to attend these market consumer needs.
In addition to that, it is already overseen that there is going to be a new tax for soft drink sodas, soft drink drinks in the Philippines in 2018. So what KOF has done to mitigate the impact is they have already increased the prices. So when the taxes come to implementation, they will be already mitigated.
So what are your earnings per share projections for the next 2 years or 3 years that you considered in your price?
Sure. Well, the EPS we are projecting for the next few years can be shown in the following EPS graph, but they will be increasing between, from 2.68 up to 4.8 in US dollars specifically, considering or assuming there are no other splits of the stock or any more dilution when they purchase a company using stocks.
You had mentioned that the company was considering vertical integration with some suppliers. Is that in the sugar production? Is that in the packaging? What evidence can you have to support that statement?
Sure. They are currently vertically integrated in Mexico with Sugar Mills, Industria Azucarera Mexicana. They own 38.6% of stake, and they are also vertically consolidating with the can producers also in Mexico, which is their largest market, where they own 37.6% of the stakes of the company.
Extend on that, they are working on packaging too. That is an impact trend in the industry. So they have been vertically integrating in that matter in order to assure the supply of plastic and the renewable sources for the production lines.
So do you consider this product to be a luxury item for the demographics in the countries that this product is available?
Sorry, can you repeat the question, please?
Is this the product, the Coca-Cola product, FEMSA, is this a luxury product, like most people buy it? Is this affordable for most population?
Thank you for the question. It is not a luxury product. The company, to be able to
Thank you, BARNA Management School. And now the judges will take a few moments to deliberate.